So for the last 2 years, market have been really busy worrying about when is going to be the top of this market. Just for a quick reminder, the narrative is really all about AI and how this is turning itself into some kind of bubble with the market that is really overvalued. Usually we use the PE ratio to consider if the market is overvalued. Right now, this PE ratio is over 20. So this technically means that it is overpriced if we consider measurement, grams, teaching. Now, on the other hand, on 2025, institutions have really sold a lot of their US stocks to buy some other stocks from other countries, other developed countries, but also emerging markets. Another quick info is that usually market tends to do about 8% per year on average, since it's how much production is growing on average every year. And right now, for the last 30 years, market have grown by about more than 10, I think 10.5, 10.6% every year for about 30 years. So clearly the whole narrative right now is that the market is overpriced, overbought, and people are just wondering what they should do, how it should go, and if buying stock market right now is still something interesting. And should they maybe look at what's going on in other countries, or maybe they just should be more focused on very undervalued stocks, or is it just a market that is completely different all of a sudden? Well, short answer is no. The market just clearly not changed. It's the same market it was 20 years, 50 years ago, and turns out every time the market is overpriced, people are just wondering why it's still rising, because it's not just a thing like when there's a bubble, it just immediately bursts. You actually see the bubble and you can actually see it grow until at a certain time it does burst. So first of all, we have to talk about market cycles. Most of you know about the cycles as this thing of we have a bull market that lasts for about 2 to 8 years, and then a bear market that lasts for at least 3 months, and worst case scenario can last for 15 months. That's usually what we are told about, but there are some more in-depth topics about cycles in stock market, especially with the US stock market. You have to consider that usually we have a phase of growth of US exceptionalism. That is how it is called outside of the US, where US stock market just overperform every other stock market, and it lasts for about 20 to 25 years on average. Then we have a lost decade. A lost decade is usually the moments when most stocks from everywhere around the world just don't perform that well anymore, and especially the US stock market, who generally during that last decade just doesn't perform at all. Historically, from 1930 to 1950, you would have been just break even. From 1969 to about 1979, you will again be break even. From 2000 to 2010, you would have been again break even. So this is why we call that a lost decade. So considering that, since about 2010, when you will be back at the break even if you would have started investing by 2000. Right now it has been already 16 years that we've seen what is called this US exceptionalism, and we're really getting close to the 20 years period. That is why people are starting to be worried about if they should keep investing in stock market, considering that it is overvalued, and usually it's always overvalued just before lost decade. Now the question is really, where should you invest your money in a lost decade? How can you actually make money when just the stock market isn't rising anymore? Well, first you have to consider something. It's that if the market is ranging for about 10 years, but just before that range, we have some very overvalued stocks that are taking a big portion of the S&P 500, because the S&P 500 is weighted. This means that the biggest stocks have more impact on the price than the smaller stocks. So the 500 stocks, if you look at the 7 first one, I think right now, we call them the Magnificent Seven. They account for about 25% of the market capitalization of the S&P 500. So 7 stocks out of 500 have 25% of the power to move the market. So that is why you have to take that in consideration. Because actually, when you see the S&P 500 ranging, It's actually because the biggest stocks were really overvalued and make the whole S&P overvalued and over concentrate. It just goes down, but it's just forcing the S&P 500 to keep its head down. So it's ranging, but actually when you look at all the companies that are not in that particular very overvalued sector, you can see that actually they are still performing well. So it's just an addition, okay? Because they have such a huge power over the price, and because they are going to perform really bad, this is why you're going to see a loss decade. But if you invest smartly and you choose your stock wisely, you can actually overperform the S&P 500 during that phase. And as an investor, beating the market is most of the time really hard, okay, especially right now since it has done, as we talked about, a really good performance. But during those phases where the stock market just clearly in bad shape, avoiding the really overvalued stocks are really a key difference that are going to make you perform better than the market itself. Now, there's also another way, which is a little bit more complex, and I'm talking about it in the next video. But this other way to invest your money would be to simply invest in other markets. Developed countries, but also emerging markets, like for example, China or South Korea. All these countries, they also have some really interesting stocks. Obviously, they are a little bit more fragile than the US companies because US institutions are just so strong.